Today on The Gold Standard.
Not everybody out there wants to have all of their nest egg involved in a hocus pocus market. And that's a very, very easy way to think about it. What are you doing to help prepare yourself for the upcoming financial crisis and crash in the markets and crash in our US dollar? What are you doing?
This is The Gold Standard from Midas Gold Group with Kenneth Russo. Hello, I'm Dave Deno. Welcome to The Gold Standard, your source for secure investment opinion and information on the advantages of purchasing and owning precious metals. Now, whether you're a novice investor or an experienced collector, this is the program that gives you a realistic weekly perspective on the state of the economy, reliable information about using precious metals such as gold, silver, and platinum to safeguard your wealth, and remarkable details about specific precious metal coins and bullion. Ken Russo is a senior vice president at Midas Gold Group, and his peers characterize him as a straight shooter who will work harder for you than anyone else. Ken, it is a pleasure to join you again this week.
Nice to be with you as always, Dave.
Our topic is, well, a bit complicated, but it's extremely important to be aware of. We're going to be talking about liquidity dangers. And Ken, in reading your recent blog on this subject, you speak of something called a derivative. That's a financial stock market term that most of us are not familiar with. So can you start us out maybe with a definition of what derivatives are and why we should be concerned about them?
Yeah, sure, Dave. And yes, it's a little bit of a of a confusing topic, and I don't expect people to understand exactly what it is. And let's start out with this question for our audience, Dave. What are you doing to prepare for when the financial system and our US dollar crashes? And that's what's really important here. One of the things we really need to be scared of is liquidity, meaning the markets aren't working correctly. And one of the reasons why there is a liquidity danger is because of these things, Dave, that are called derivatives. And a financial derivative is defined as a security whose value depends on or is derived from an underlying asset or assets. So think about it as kind of like a contract, Dave. But more importantly, think about it as a contract that may be leveraged 100 or 200 times. So let's think of it as a contract, a physical contract on a commodity or a bond or a stock or a cryptocurrency or even an index like the Dow Jones Industrial Average or the S&P 500. And let's think about all the contracts that are taken out on these underlying assets. And what does that do, Dave? It increases volatility. It increases risk. It increases the bubble. And remember, I don't know if the audience has been listening for, as long as we've been doing this, Dave, we are in the biggest bubble in the history of markets that will burst. And these derivatives, Dave, are only making the markets more dangerous, bigger, and more volatile and more violent. So I would like people to think about it as that way. Contracts on these underlying assets, that's making the markets more dangerous, more risky, and more violent.
Isn't it like Wall Street to use vehicles and terminology that make it very hard for those of us who are average investors, make it very hard for us to truly understand what they are doing, how they are manipulating our investments? We might say that a derivative, in other words, is a financial asset like the ones that we have referred to often in our program. People invest in them. They invest in currencies or stocks or bonds or commodities or even cryptocurrencies or, as you said, equity indexes. Are you saying that if my investment fund manager has me invested in these stocks, bonds, commodities, or cryptocurrencies, that I'm actually invested in derivatives?
I would say, Dave, that probably not directly. People that are listening to this show are not invested in derivatives. Most of the institutional investors out there, the big banks and the hedge funds and the pension funds, and that's what I think people should be very concerned about is like a pension fund. These are the entities that are severely invested in, like, say, government bonds,
Mm.
and they need to kind of hedge their risk. And when these entities get on the wrong side of a trade, they're forced to do things, forced to liquidate, forced to cover their shorts. That increases the volatility in the markets, and we see huge moves. We saw this just a couple weeks ago, Dave, as the pension system in the United Kingdom was on the brink of failure. Now,
Mm.
think about this. We've gone through 40 years of a joyride of money printing, abnormally low interest rates. And just in the last 5 or 6 months here, we're starting to see an increase in interest rates, right, Dave? And this unwinding of all of this stuff to try and fight inflation. And already the United Kingdom's pension system had a problem where the Bank of England had to come on in and provide liquidity. Now, these are not the things that people hear of all the time. These are the things that Wall Street wants to keep quiet.
Mm.
But why would the pension system in the United Kingdom be the only thing that's going to be in trouble? Hedge funds are going to go out of business. Institutional investors are going to have a hard time. There's going to be a banking crisis. Where there's smoke, there's fire, Dave. And as you know, right now, there's a lot of smoke. And it's all due to this money printing. It's all due to debt. And the derivatives that are on top of all of this stuff, it's just going to make it more dangerous, more volatile, and more violent when those moves occur.
It's a very, very scary proposition, I would say, for anyone who has worked their whole life to receive some sort of a pension, whether it's a government pension or a company pension. Very scary to think that that pension could go belly up, so to speak, that it could disappear, that the rug could be pulled out from under them. It all seems like Wall Street hocus pocus, that goes on behind the scenes, details we don't really understand.
Yeah, David, and it makes it almost we question, well, is that what they want to do? That they want to make things so complex that we don't understand what's going on, and we just say, well, whatever. But when it comes to our money, when it comes to our retirement and our nest egg, it should be the exact opposite. It should be simple to understand. It should be based on fundamentals. Our retirement and our money should be strong, shouldn't be weak. It shouldn't be leveraged to the hilt. And once again, Dave, I would ask our audience, because I know you've done this, what are you doing to prepare financially for when the financial system and dollar crashes? Because that situation, based on everything we're talking about, liquidity, derivatives, stock market bubbles, reckless central banking, politicians just doing whatever, spending just to get elected, making promises to enrich themselves and their buddies. All of these things are very real. And for people to kind of just pretend that they're not real is going to be very expensive. So the point of our discussion today is that the market, Dave, is as risky as it's ever been. The debt situation is as dire and as big as it's ever been. The outcome, to me, is inevitable. It's all based on greed. Now, what could we do to protect ourselves for when all that stuff falls apart? We're not financially ruined. And that's kind of what I would want people to think about, especially, Dave, as you and I discuss this topic.
A reminder here that you're listening to The Gold Standard with Ken Russo from Midas Gold Group. And our topic today is liquidity. Ken, how does then gold, physical gold, counteract the inevitable failure of derivatives?
Well, physical gold, that's right, Dave. And that's very important because there's derivatives on the gold market as well. You have all these central bankers and they leverage possibly 100 or 200 times the amount of gold and silver that are out there. And they make bets as if the price is going to go up or down. And that's why the paper market is not really owning gold or not really owning silver at all. The physical, tangible asset, Dave, in your own possession, money out of the banking system, is metal you own. Gold you hold is gold you own. It's not paper. It's not a contract. It's not a ETF. It's not a share in a mining company where you would only make money if the company finds gold or if they don't. This is something that will always be there. Gold will always have value. If the banking system goes through a period where there is a crash or a crisis, which, like I said, I think is inevitable, your physical gold and silver that you have won't be affected by that. Not to mention, it's always had value. You just can't print gold and silver bars and coins out of thin air, Dave. It's a long process. So you got to look at it as a way to say, hey, how could I make my nest egg bulletproof? How could I make my nest egg strong? How could I make sure that there's something there for my family, no matter what happens to the market or to me? And the easy answer, the straightforward answer to us at Midas Gold Group is to take some of your assets, Dave, out of the paper markets, out of your retirement plan or out of the banking system, convert it sideways, tax-free into physical gold. And no matter what happens to the markets because of these derivatives, because of the reckless behavior, no matter what, gold's different because we know it will always be there for us and it will always be worth something.
We're going to continue our topic of liquidity dangers just a little bit later in the program, and we're going to highlight several other tangible ways to convert your wealth into the security of gold, some of which I've already referred to. But first, a reminder that you are listening to The Gold Standard with Ken Russo from Midas Gold Group, and coming up, we're going to look at a specific precious metal that you can use to safeguard your wealth, and that's coming up right after this.
Sebastian Gorka here, urging you to consider converting your cash savings and a good portion of your investments into gold with the Midas Gold Group. Because if you're a conservative or MAGA supporter, the rhetoric coming from the acting president is appalling. Biden has called companies and individuals who support MAGA policies extremists and semi-fascists. And it's only a matter of time before the administration controls our finances with digital currency. Biden already signed an executive order preparing for digital currency with 87,000 new IRS agents who can monitor our every transaction. I recommend calling veteran-owned Midas Gold Group to safeguard your wealth with physical gold before it's too late. Gold is private and traditionally holds its value when economies crash. Go to MidasGoldGroup.com or call them at 855-322-GOLD. That's 855-322-GOLD. It's gold you can hold. 855-322-GOLD. Call today.
And we're back with more of The Gold Standard, brought to you by Midas Gold Group with Ken Russo. I'm Dave Deno, and our topic today is liquidity dangers. By the way, if you live in the Los Angeles or Phoenix area, we invite you to come and visit our local office to meet with us in person. For the address and directions, just log on to our website, MidasGoldGroup.com. That's MIDAS, MidasGoldGroup.com. For those of you listening in other cities, call us directly at 855-322-GOLD, 855-322-GOLD. By the numbers 855-322-4653. Now, it's time for our featured precious metal product, and today it's the Credit Suisse Gold Bar. And Ken, I turn to this form of pure gold because I have often heard you say that gold bars are actually a better bargain than gold coins, that they cost less than a similarly weighted gold coin.
Well, that's true. You could own more gold for your money, but there's pros and cons to every product. But once again, what's a product, Dave, or what's something that someone can do to protect themselves and prepare themselves financially for when the financial markets and the US dollar crash? And one easy answer would be, well, I'm going to take some of my paper and I'm going to convert it into some gold bars. And Credit Suisse is actually my favorite gold bar. It's a 24 karat gold bar, Dave. It's a basic form of pure gold. You're not paying big premiums for artwork or government coinage or minting, although the coins these days are pretty reasonably priced. It's pretty just basic. This is what you get, quality, Swiss gold.
It has an impressive appearance, doesn't it? Can you give us a description?
Well, I love the white packaging, and then I love the 24 karat gold color of the bar. It just is a great presentation to me. It's very eye appealing. These are minted by Valcambi SA in Switzerland. Most popular are the 1 ounce Credit Suisse gold bars, Dave, that we kind of see investors, especially those that are looking for larger diversification orders. It's a quality manufacturer of almost 40 years. The company stands as one of the globe's biggest manufacturers of bullion and minted ingots. A lot of people refer to bars as ingots. Each bar, Dave, comes with accompanying assay card to officially certify the weight and the purity. We do test all of our products, folks, before people take delivery of their gold, and I know they're tested for sure through the people that we do business with at these mints, as we own gold coins and gold bars directly from the mints themselves. All bars are IRA eligible that are in 24 karat gold and stamped with the serial number, Dave. Buyers have verification that the bar was assayed when the serial number matches on the bar and on the accompanying assay certificate. So that's something that people should remember. Very simple, but not something that people think about all the time. The reverse side of the bar features an attractive design where the Credit Suisse logo is repeated in a diagonal pattern. These popular bars, Dave, are a product that is recognized worldwide. Each of them represents an affordable way for investors or collectors to purchase gold. So like I said, Dave, there's clients out there that are wondering what they can do to prepare for the upcoming financial crisis and prepare for the markets and the US dollar when they do crash and lose significant value. One easy thing you can do is to take your paper assets, or some of them, and move it into a quality gold product. This week, our quality gold product is the 1 ounce Credit Suisse gold bar.
And I love that listeners can actually see what they look like by logging onto your website, MidasGoldGroup.com. Ken, thank you for the description. Coming up in a moment, we're going to continue our topic of liquidity dangers with Ken Russo from Midas Gold Group, and that's coming up right after this.
Sebastian Gorka here. More than ever, it's critical to convert your cash savings and a good portion of your investments into gold with the only gold company I recommend, Midas Gold Group. Why? Because those pulling the strings behind the Biden administration want to know everything about your finances. They had Biden sign an executive order preparing for a digital currency. Midas Gold Group sees tyrannical implications, especially for MAGA supporters. Digital currency will record all your financial transactions, with 87,000 new IRS agents able to monitor your accounts. So I recommend calling veteran-owned Midas Gold Group to safeguard your wealth with physical gold before it's too late. Gold is private and holds its value when economies crash. Protect yourself and your family. Go to MidasGoldGroup.com or call 855-322-GOLD. That's 855-322-GOLD. It's gold you can hold. Call 855-322-GOLD.
And we're back with more of The Gold Standard, brought to you by Midas Gold Group with Ken Russo. I'm Dave Deno, and our topic today is liquidity dangers. Now, if you live in the Los Angeles or Phoenix area, you can actually come and visit with us in person at our local office to meet with us and actually look at some of the product that we talk about. It's pretty impressive. For the address and directions, just log on to our website, MidasGoldGroup.com, M-I-D-A-S. MidasGoldGroup.com. For those of you listening in other cities, just call us directly at 855-322-GOLD, 855-322-GOLD. By the numbers 855-322-4653. Now, let's return to our topic, liquidity dangers. Ken, in your blog that I read on this subject, you cite a warning from Warren Buffett. And I mean, if anybody knows the ups and downs of the market, it has often proven to be Warren Buffett.
Yeah, and let's not forget, Dave, that there's problems that are happening right now. This is just not hearsay and, not rumor. As we mentioned before, the Bank of England provided liquidity to the pension system just last week. A little while before that, the Bank of Japan did some so-called quantitative easing already, and in one day, the 10-year bond didn't even trade. That's illiquid, meaning if you wanted to sell something, there's no buyer. Remember, folks, whenever you're selling something, there's a buyer. Just like whenever you're buying something, there's a seller. There has to be both sides. It has to be balanced. But when you have zombie markets where money's just printed out of thin air and then they just buy these bonds to support the market and then they just put them on the balance sheet, well, what's going to happen when they want to sell them? Who are they going to sell them to? And Warren Buffett, obviously, probably the most successful investor ever, back in 2003, Dave, 19 years ago, Warren Buffett warned that the rapidly expanding derivative markets are a threat to both the economy and to the markets and to the parties that deal with them. That's what I'm very concerned about. A lot of these parties like hedge funds, pension funds, and whatnot that deal in these derivatives will probably be insolvent, some of them, and go belly up. And then what happens to your assets? Well, I guess they just disappear. But Buffett went on to call derivatives, listen to this, Dave, a financial weapon of mass destruction.
Wow.
And that these derivatives pose a big risk, Dave, just a huge, huge risk. Buffett additionally said that derivative contracts also invite erroneous accounting because they are often valued on assumptions that can be wildly inaccurate. Derivatives, Dave, are already causing a serious liquidity problem in the global financial system. It's already drowning in debt, this system. It's only going to get worse. And Dave, the answer to all of this is to not just print money, is not to take on more debt, and not to have governments still spend recklessly. It's only going to get worse. This is a situation that is not going to go away. It's very dangerous. And in my opinion, it's probably going to be the ultimate cause of when the markets do melt down.
A reminder here, you're listening to The Gold Standard with Ken Russo from Midas Gold Group. And today our topic is liquidity dangers. So Ken, how can then a person get their funds out of derivatives into the safe harbor of physical gold? What's the process?
Well, it's pretty straightforward, Dave. And what I was trying to say before was that there's a mega catastrophic risk to all that's going on right now with these derivatives, and there's a meta catastrophic risk of losing significant amounts of your wealth and money. Before that happens, what you can do is you can take some of those paper and liquid assets out of the banking system by a check or a bank wire or a personal check. You can convert that paper into physical gold and silver, take delivery of that physical gold and silver, put it somewhere safe. It'll be there when you need it. That's one way. The other way is possibly you have a retirement account, an existing IRA, or maybe an employer that you used to work for, maybe a 401k or that sort of thing, or maybe you still work at the company, but maybe you've been there for a long time. Maybe you're vested. You can do a rollover, or you can do a transfer of your retirement funds, and you can take some of those retirement funds, Dave, and you can convert it into a tangible asset like gold and silver, bars and coins, something that you know will be there when you need it. Much different than just keeping paper that's connected to the banking system, that's subject to these derivatives, subject to an illiquid market, subject to manipulation and hocus pocus, like you said. Hey, listen, Dave, not everybody out there wants to have all of their nest egg involved in a hocus pocus market, as you would put it. And that's a very, very easy way to think about it. And like I said, Dave, what are you doing out there to help prepare yourself for the upcoming financial crisis and crash in the markets and crash in our U.S. dollar? What are you doing?
I love the fact that you and the folks there at Midas, you are not salespeople. You are facilitators. You help us to make the right decision, and you help walk us through all of the steps to make that happen. And I appreciate that so very much. And that's going to bring us to the end of our time together today here on The Gold Standard with Ken Russo, brought to you by Midas Gold Group. And a reminder, opinions given here are not intended to be specific to your investment strategy, but rather general information to give you a better understanding of investing in precious metals. For answers to your questions, as I have encouraged you to do so, call Midas Gold Group at 855-322-GOLD, 855-322-GOLD, by the numbers 855-322-4653. And the website is MidasGoldGroup.com. The Midas Gold Group is proud to be America's #1 veteran-owned gold dealer, supporting veterans' causes with a portion of profits donated to the Wounded Warriors Project and the Semper Fi Fund. So your investment in your future is also an investment in the future of those who have bravely served the cause of freedom. Again, the number to call to speak directly with Midas Gold Group is 855-322-GOLD. One more time, 855-322-GOLD. Hey, Ken, Thank you so much for your time again today.
Nice to be with you as always, Dave.
I'm Dave Deno, and I hope you'll come and join us again next week at this same time for another edition of The Gold Standard.
The Gold Standard was brought to you by the Midas Gold Group.